This show has never been solely about investments. We've talked about anything that affected people and their money.
From Fox Business Headquarters in New York City, the new Wall Street Week.
Welcome to Wall Street Week, the show of record for long-term investing. I'm Anthony Scaramucci.
I'm Gary Kaminsky. There's no denying it. 8 years after the financial crisis, the markets continue to move based on what the Fed says it will or won't do.
It's true. And this month, the market's falling when investors thought a rate hike would come in June. And then recently, some big rallies when sentiment shifted, accepting the possible rate hike. Keith Banks is the president of U.S. Trust Bank America Wealth Management. Rick Schultz is a managing director and wealth advisor from Neuberger Berman. Welcome to the show, guys.
Good to be here. Thank you.
Keith, I'll start with you. It's 8 years later. Is it still all about the Fed?
I think it's all about the Fed. I think it's even more about earnings. You know, we view it, Anthony, right now that the PE multiple is around 17 times. They're not going to expand much from here. So to make a case for higher levels in the market, you have to make a case for stronger earnings.
So, but a 17 historically is a high number for S&P earnings. I know, isn't it typically 15, 16 a fair valuation?
I think it's at the high end of a range. And in fact, we just actually at U.S. Trust went more neutral on equities in a tactical allocation shift. And the reason we feel that way is because, again, with multiples at full levels, number one, and with the summer coming with possible rate hike fears, U.S. presidential election, you got the UK referendum, a lot of stuff to worry about, and we think that could cause some downside in the markets over the near term, and so we pull back to a more neutral weighting.
Rick, what about you? How do you see the world, the markets, the Fed, earnings?
Gary, there are no layups. At the beginning of this year, when the market dropped 8% in the first 2 weeks, it was very frightening to investors. They were very concerned about what to do. Some even called and said, should we go to cash? You had a number of firms say that oil might go to $20 or $10 a barrel, 40% chance of recession. There was a lot of anxiety. So today, the recovery from February 11th through the end of March, we had a positive return in the S&P of almost 1%.
Rick, when you're talking to clients, it's 8 years after the financial crisis. Do they feel the palpable pain of the financial crisis, it being almost a decade away from us?
It's a scar, not a wound.
Yeah, exactly.
Right? It really is still there.
Yeah.
And when you see the volatility which we had in January, we had almost 65% of the trading days that market moved plus or minus 1%. And when you see that visibly on all the shows throughout the day, clients, investors get concerned, especially when they invest irreplaceable wealth.
Keith, you see the same at U.S. Trust? You see the clients continue to look at 2008. It's fresh in their mind every day?
It's there. It's not paralyzing them, but it's there. And I think the way it's manifested itself with our client base, and it's been consistent with our strategy, is we want to be fully diversified. We've seen a real increased interest in tangible assets, things like real estate, farmland, timberland. People like those kinds of assets because, number one, there's a low correlation to financial assets, which is good, especially to your point, Anthony, 8 years in. And number two, people do believe when inflation comes back, it's a good hedge.
I'll address that because 8 years in means there's a likely recession on the horizon, right? Because our economy goes into recession roughly every 7 years over the last 80. Is that what you're referencing?
Well, we're saying, actually, we think we could be looking at another 2 or 3 years of continued expansion in both the economy and growth in the markets, because what you're not seeing this far in are the typical excesses. Interesting point, average hourly earnings typically at this stage of the cycle would be growing in excess of 3%. Closer to 2%. We don't see 3% average hourly earnings growth for another 12 months, and the danger zone typically has been 4%. We don't see that happening out until probably 2018, 2019, which means the Fed doesn't have to rear up and try to slow things down. And the big catalyst for all of that is inflation this many years in still being so low.
Yeah, amazing.
Rick, let's take it to clients. I've had the opportunity over the years to work with you and work directly with your clients, and you've got incredible relationships.
Thank you.
Keith mentioned about the election, as well as a number of other issues this summer. I have to imagine you get a lot of calls these days, clients asking you about how that's going to impact portfolios, the market, and what do you tell them?
Well, I mean, it's a boom for the 24-hour news channels, right?
Well, we love it over here. Yes, we do.
Cable gods are good. Thank you, cable
Everybody
gods.
is loving
Right.
this election because you don't even have to have another agenda because the election gives you enough to talk about almost every single day. So when you see that as an investor, you hear that, it creates anxiety. The only thing you can really do, because none of us even expected to be in this situation,
Right.
and now where do you go from here, is you have to protect your portfolios in a way of being more defensive and focusing more on yield than growth.
So are you doing that now, or are you waiting to see what happens in November?
No, I think tactically you're doing it now.
Is this 1980, Keith? Where people have something to fear, but they don't really have something to fear?
You know, it's interesting. This has been, despite the fact that this economic expansion and the bull market has gone on for so long, it's been the most joyless period of money making I've ever experienced. And it gets back a little bit to the question you two have asked, which is it 2008? People just keep worrying about the next thing that could come.
Next leg down.
There's been a lot of things that people have been given to worry about. Fortunately, except for some brief pullbacks, and we saw one at the beginning of this year, it's not been sustained and the rally continued.
All right, Keith and Rick, stay with us. We'll be right back. Welcome back to Wall Street Week. We're joined by Keith Banks and Rick Schultz. The election is overshadowing so much of what's happening in America right now. Keith, I know you guys just did a survey with your client base.
We did.
How important was the election in terms of people thinking about the economy and their investments?
So it's actually a survey of non-U.S. trust clients, but wealthy individuals. It looms large. So interestingly, among business owners, the election was the #1 concern on their minds as they think about the future. More generally, people are actually optimistic, thinking that the election would bring about positive change, a positive outcome.
Is that something that you would share, that sentiment, as you're leading a company, a financial services business?
Well, look, our advice to our client base is that when you look back over time, interestingly, elections don't have a big impact on the broad market. They can have big sectoral impact depending on the policies that the new electee comes in with, but it doesn't have a sustained impact. So.
Rick, Jamie Dimon was on the show last week, and he said that the election is not going to have any impact. Doesn't matter if Hillary's elected or Donald Trump on the overall market. Remember that, Gary?
Yes.
So what do you think of that?
I do think elections have consequences. It's going to modify behaviors. And from an investor standpoint, it's going to make them either more nervous or actually more optimistic.
So, Rick, you talked about having to prepare now for what may happen in November. Let's talk about how you position portfolios in terms of what you want to do with asset allocation for your clients' objectives, which is preserving wealth and growing wealth.
Gary, great question, because that's all that really matters, right? All this noise, what goes on globally, we can't control any of that. An investor can't control.
So this is the show for long-term investing. I come to you, what do you tell me?
The way I look at the whole investing landscape is how much do I want in growth and how much do I want in income? Where do I get yield? And yield acts as an insurance policy against changes in changes that could come. So today we're more defensive. We're more invested in a variety of different investments, and I would say we're looking at a 40 to 50% allocation to yield and maybe on the balance on growth, because to Keith's point earlier, the S&P at 17 times doesn't create a lot of optimism.
What sectors do you like, Keith, specifically?
Well, we think what's going on, and we share the sentiment, is a rotation out of growth into more cyclical, value-oriented sectors and stocks.
This late in the cycle, we're going to go with cyclicals.
Yes, and you can see the relative performance is reflective, and we think it's going to accelerate as we move forward. So we like areas like financials, energy, we like industrials, materials, again, consistent with that theme of cyclical and more.
Well, then you can't expect a recession in 2017 if you're moving into those spaces now.
No, we're not. As I said earlier, we think we could see another 2-3 years of growth. In fact, if we were to bet today, we think this could rival the longest expansion, which was 10 years in U.S. history. So,
You know, we opened the show saying that 8 years later, it's still about the Fed every day. And what they say and how they tweak their commentary in terms of what happens with the markets.
Fed-centric world.
So if you know that's the case, how do you advise clients to think about the commentary every day in terms of a long-term strategy?
Well, again, we try not to get hung up and allow our clients to get hung up in what I call the data point du jour, which is good data point, bad data point, market up, market down. We have a strategic asset allocation, number one, and then we'll tactically adjust it.
Do you think
which we
clients
just did.
get too nervous? You said they were going to cash in the first part of the
They were
year.
asking about going to cash,
So
right?
do you think clients get too nervous? Is there a message out there for your clients about being long-term and being more patient?
Yeah, again, our view is you cannot zig and zag and think you're going to make money. It's impossible. We have no insight into that. They have no insight. Our job is to keep them on a longer-term course. We're comfortable tactically reallocating. As I said, we just went to a more neutral stance versus equities. But if the market were to pull back this summer by 5 to 7%, we would go back to an overweight position.
I think personally, Gary, this is a huge reason why people need the services of you guys. Is just
Absolutely.
to calm people down and get them trained to think about this stuff way long term. The market is a voting machine in the short term and a weighing machine in the long term. That's a great Warren Buffett aphorism.
There's a lot of things that you can do yourself. We're in that kind of economy, we're in that kind of world. But as I know, and as actually the four of us know, when you start thinking like in January,
Gary
February,
gives himself his own haircut, though. I know he's doing that by himself.
well, it's better than paying $500 for this one, man.
That's cheap, man. That's $7.95.
But it is true. When you have those conversations with the clients, it's the kind of thing, some call it hand-holding. But, Rick, I've been there. I see how you do it. How important is it for the viewer out there to understand, because we're going to have volatility this summer, to stay the course? It's
huge. Emotional changes that clients feel or want to make usually end up not delivering in a positive way. If you look at fund flows,
8 out of 10 times, 9 out of 10 times, you've been.
I
doing this for a
don't
long
have
time.
the statistic, Gary, but
guess.
fund flows. If you look at fund flows from the investors, there's data out there that says if the S&P returned 9%, individual investors return 3% because they usually make decisions at the wrong time. So I learned this from a colleague of mine. I have a 3-call rule. And by the time I get a third call where the person's really upset, then we make major changes.
All right, I hear you. All right, well, we want to thank you guys. Keith Banks, Rich Sheltz, thanks for joining us.